Hi everyone, this is Emanuele Carluccio. I am the chairman of EFPA, the European Association of Financial Advisors and Planners, and I'm very glad to open the presentation of the think tank results that we organized during 2021. Let me introduce a few words on the EFPA Association. As I just told, EFPA is a European association grouping together 12 local members, 12 local EFPA in the different European countries. And our main task is to offer certification on knowledge and competences of the people involved in financial advisory and in financial planning activity. At the end of 2021, we reached more than 70,000 certificate holders if we group together the different countries and of course also UK and Ireland, where we just did a kind of MECPIM activity offering a grandfathering on the local certificates offered by different associations. The different certificates we offer are four. We have the European Investment Assistant, which is the basic level. Then we have the European Investment Practitioner. Then we have the European Financial Advisor. And finally, the European Financial Planner. At the end of 2020, beginning of 2021, we decided to launch also another additional certificate, a kind of add-on certificate devoted on ESG matters, which was quite successful. Every 2 years, we organize the think tank, which is the reason why today we would like to share with all of you the results we got. During the think tank, we like to get in touch mostly with our certificates holders spread all over Europe. We like to get them involved in collecting some ideas, some proposal, and discussing together on different thematics, on different activity they run every day. Generally, we start with the research. We decide a couple of topics to be analyzed, and for the 2021 analysis and research, we decided to collect a different reaction on two different topics. The first topic is the transfer from creating returns on investments to create income. The purpose of this first thematic is to understand which are the real goals of our clients, which is the real time horizon they have when they build their portfolio, and what is the pension gap they feel, and how do they react in order to try to solve the problem of the pension gap. The second topic is, of course, linked with the coronavirus, which, of course, it impacted very much our activity in the last couple of years. And the second topic is the winners and the loser after the coronavirus. What does it mean, winner and loser? We wanted to understand if the coronavirus got a very big impact on the risk tolerance, or if you prefer, on the risk appetite of our final clients, and if we register many changes in the real asset allocation of their portfolio. And it was nice to collect a different opinion coming from different countries and also from different kind of people working in the financial sector. I give the floor to Martin Sirucek, our SQC member representing Czech Republic, in order to present the results of the first working group. And then I will give the floor to Paul Ryan, who is our SQC member coming from Ireland, who has been the coordinator of the second working group, taking care about the second thematic on winners and losers after the coronavirus. At the end of their presentation, there will be Matthew Connell, who is the chairman of our SQC, has been the chairman of our SQC for the last 3 years, and he will collect all the different results, the main results that we got during this think tank. Of course, before giving the floor to them, I would like to thank all our certificate holders who participated very heavily on this analysis, on this research, also offering their huge contribution to the discussion we got in the different working group we have been organizing during all the second semester of 2021. So I'm very glad to register that we got a huge participation and the results have been very interesting. And final word to Matthew. He has been the chairman, as I told before, in the last 3 years. He will end his mandate exactly with the results of this think tank. So this is a great opportunity to thank him again for the big and huge support he offered to EFPA, Europe in general, and to the SQC in particular. Thanks, and please the floor to Martin Silkes. Thank you so much. Bye.
So hello everyone, my name is Martin Širuček and I am the EFPA SQC representative from Czech Republic, and at the think tank 2021 I was the leader on the topic of the transferring from creating returns to creating income. And now I want to present you the results of this part of the think tank 2021. So my part of the think tank 2021 survey focus on the topic of transfer, creating the returns into creating the income. And in my part of this survey take part around 750 financial planner, financial advisor across the countries in Europe. And this survey focus in general on clients' preferences, what is meaning if they prefer standard investment instruments, standard financial assets, or if they prefer more or less, for example, physical assets like precious metal, or if they prefer or if they have more popular the cryptocurrencies and these new trends and new assets or speculative instruments. The survey also focus on the topic why clients invest. General, what's their expectation, what's their investments or private goals, what they want to reach, what goals they want to reach with the financial planner or advisor. And maybe according to the results, we find there 5 or 6 key findings, and the first one focused on the reason why clients invest, why they cooperate with a financial advisor or a financial planner and invest their money. In general, across all countries, the main reason why clients invest their money is to be prepared for retirement age, what is meaning to create some amount of money, some financial pillow for this life period. And second most important reason is to protect the capital or the assets against inflation. If I mention that the clients or the main reason is to be prepared for retirement age, it is also due to that according to the result, in general, the clients across all countries, maybe only except Poland and Italy, they are very disappointed and dissatisfied with the state pension system. But this topic, the satisfaction with the state pension system, I will mention in a few minutes. So in general, the main reason why clients invest their money is protect the capital against inflation, because in some countries the clients also want to transfer these financial assets for a next generation. And the most important reason is to be prepared for retirement age. in Poland, Hungary, and Italy, was interesting that the clients use also investment like some assets or some financial pillow for unexpected situation. So that is meaning that these clients use investment only like a short-term reserve for some unexpected situation. The second key finding focused on the popularity of financial assets. In general, the most popular investment instruments across all countries were mutual funds and ETFs, but also investment into the real estate. What is pretty good and interesting, and I appreciate it, that in general, across the all countries, clients don't use the cryptocurrency or crypto assets like instrument for investment, because at least based on the level of financial literacy in each country, the clients know that it is not investment instrument, it is very risky and speculative instrument, short-term instrument. And they know that with these speculative assets, they are not able to fulfill their long-term financial plan. According to the popularity of mutual fund, real estate, or direct investment into the stocks and bonds, two interesting results in Slovak and in United Kingdom, that clients in these countries, they don't prefer the investment into the real estate so much like in other countries. And my explanation of that, my private explanation why clients in United Kingdom, for example, don't prefer the real estate so much, is that in UK, especially in London, the price of real estate, like the flats or like the condominium, is the most expensive in the whole Europe. The average price there is around 15,000 euros per square meter. And that's maybe the reason why the clients don't like the direct investment into the real estate or investment into some real estate mutual fund, because the surplus or the expected profit from renting these flats or office spaces is not so big as in other countries. But in general, mutual funds or real estate, the most popular financial assets. The popularity of the financial assets maybe correspond with the sensitivity of clients' decision on the inflation, because the third key finding focus on the expectation or on the topic how inflation affect clients' decision. If the clients change their financial plan, long-term financial plan or not. And according to the result, and what I appreciate is that there is no client's reaction on growing inflation. The clients continue they fulfilling their long-term financial plan, and maybe it is also according to the discussion with their financial planners or advisors that the financial plan is built pretty well. It is not sensitive on growing inflation or some inflation waves and inflation trends, so they just really fill the plan without any portfolio changing, moving to more risky or more trendy financial or investment assets. They don't provide any portfolio rebalancing. Only in Hungary, where the lowest, where was found the lowest reaction, what is meaning that in Hungary we can say that the clients there provide any steps according, some steps according to the growing inflation, and that they move to the real estate or to the more risky asset. That was just one interesting result in comparison with other countries. The fourth finding was focused, we can say, on some new investment trend. First of all, on the ESG investment, because we want to know if really this new trend, new era of investing is really popular in the countries. And according to the result, ESG investments are preferred most by the mid-age group, what are clients from 30 to 40 years old. And for example, my private expectation was that this type of investment will be more popular by the youngest group, what is meaning less than 30 years. And second, I also privately expect that, for example, this type of investment will be more popular in Germany, in Austria, or in United Kingdom. But according to the result, the popularity there is not so high as I expected. And yeah, I stopped the sharing. And the fifth key finding was focused on the popularity, or on the satisfaction with state pension system, what correspond with the reason why clients invest. And as I said, the clients invest. The reason why clients invest is, first of all, to be prepared for a retirement age. And according to the result, as I said, really in all countries, there is a high dissatisfaction with state pension system and state contribution, except only in Poland and Italy, where the clients are not so radical. They are not so dissatisfied with the state pension system, but in general, the clients across Europe really don't believe to the state that they will receive some pretty good state contribution in the retirement age. And at least the clients appreciate some state incentives like tax benefits by a state contribution. And the last part, or last key finding, focused on the financial literacy. I said that according to the financial literacy in each countries, the clients prefer or like more the standard investments instruments like the mutual fund, ETFs, real estate investment, or direct investment into the stocks and bonds, and that the clients don't use the crypto investments, crypto assets. But according to the result, there was found interesting result or results because there was a pretty nice difference between the financial literacy in Western Europe and in Eastern countries, because the worst in general across the whole Europe, the worst financial literacy was found by the youngest clients, what is meaning the clients between 15 and 26 years old. But in general, in Eastern countries like Czech Republic, Slovak, Poland, also by this group, the financial literacy was really the one of the most worst across the whole Europe, and vice versa. In a Western countries like Germany, Austria, or United Kingdom or France, there is the financial literacy on a higher level. By the youngest group, it is also the financial literacy pretty poor, but more and more higher than in these Eastern countries. So that's all from my side. That was the 6 main key findings of the think tank 2021 from the part what was focused on the transferring from creating returns to creating income.
Good morning, everyone. My name is Paul Ryan, and I am the EFPA SQC representative from Ireland, and I will be presenting the results of Part B of the EFPA Think Tank 2021. So I'll just share screen and then go through the process for this presentation. And just to summarize some of the broad objectives of this part of the think tank was really to ask ourselves a number of questions. Who would be essentially the winners and losers after the coronavirus passes? And we were going to ask ourselves, what do we consider will change based on the traditional asset allocation? Will investors' risk horizons for families change? In terms of a model portfolio pre and post the pandemic, will that change? Given that we are looking at this particular crisis, what are the similarities it could be with the global financial crisis in 2008, and will there be any differences? How will the asset allocation differ post the crisis? Will there be more equities, less equities, more bonds, less bonds? Will there be a movement more towards alternative assets and so on? And indeed, how long will this particular crisis last? And are there going to be any fundamental macroeconomic differences, such as, for instance, an increase in government intervention? I want to thank a number of the participants that were involved in this side of the survey. It was a European survey, and the survey questions were constructed by myself together with my colleagues from Spain, all the way up to Slovakia. So Ingo, Deborah, Thomas, Zolt, Simon, Kevin, Lucas, and indeed Avika. So it was very much a team exercise in terms of the development of this survey and then dispatching that survey out across the EFPA membership to look at what are the broad themes that are going to or have indeed emerged. So let me go through exactly what we're doing. So what I'm going to list on the various slides here are the individual questions, plus a summary of what the principal responses were, or the main responses that came out of the survey. So the first question was asking about the likely trajectory for the global economy over the next 1 year. And we gave a number of possibilities in terms of low inflation, low growth, going to high growth, high inflation, and the third possibility there, stagflation. Interestingly enough, over the next 1 year, there was a strong preference for high growth and high inflation. And we can see that has, to a certain extent, manifested itself on a global scale due to the supply chain shortages effectively that have happened, and also the increase in commodities, notably oil prices, as the economies have started to improve. Looking at it then over the next 5 years, because we wanted to look at it both from a more short term and indeed a longer term perspective, and again asking the same question. This time though, the responses were a little bit more ambiguous. That 47% of the responses went for high growth and high inflation, with a slightly smaller percentage going for low growth and low inflation with low interest rates. So again, a little bit of a difference depending on the short-term response and indeed the long-term response. And what we also wanted to consider, well, what do you think will happen in your own domestic economy as opposed to what's going to happen in the global economy? And again, we asked this question in two parts, one over 1 year and then secondly over a longer, which is the 5-year horizon. And looking there for the 1 year, we've got a very similar response for the domestic economy compared to the global economy. So there wasn't much difference in what participants thought in their individual economies versus what they would have thought in terms of the global economy. And these were very much measured as well in the next slide here, where we look over the next 5 years, and we might talk about the long term. And again, a little bit more ambiguity compared to the short term, with 39% going for high growth and 36% going for low growth. But again, high growth marginally dominating, but inflation expecting to be a little bit persistent, as it was indeed in terms of the global economy responses. And then we asked ourselves, well, then over the next year, given you have a current model asset allocation, in other words, a certain amount of the portfolio that will be allocated toward equity, certain amount towards bonds, etc., how do we see that changing over the next 1 year? And we gave the question there in terms of the typical asset classes over on the left-hand side, equities, real estate, going all the way down to alternatives, precious metals, etc. Interestingly here, the response was that in terms of being overweight, very much a strong preference for equities, and that equities would be a bigger proportion of the model portfolio going forward. Normally neutral a little bit on real estate, and that very much mirrors what happened in part A of the survey, which Martin Surchek has already referred to. And again, because of the low interest rate environment, a major underweight in government debt, but a little bit more of a neutral stance in respect of corporate debt. So a little bit of shifting away in terms of debt into corporate debt as opposed to government debt, perhaps changing yield in that way. And of course, given the low returns to cash, a very clear majority are neutral to underweight in cash, with the next preference being towards overweight in terms of alternatives. And we'll look a little bit later at what those likely alternative assets are going to be. Then I'll ask over the same thing over the long term. So in other words, looking at a 5-year horizon, and again, the same asset classes, and again, the same type of pattern emerged, almost identical to what would happen over the 1 year. Again, very much overweight in the equity asset class, being neutral on real estate, and significantly underweight in government debt, with a lot more neutral to being a little bit overweight perhaps in corporate debt, and with again cash being avoided given the low interest rate environment which is expected to prevail. Now, the next important thing is, well, what would happen in terms of the correlation between asset classes? Because the higher the correlation, the less benefit there would be from diversification. And we asked ourselves that over the next 5 years, whether participants across Europe thought that the correlation was going to increase, decrease, or indeed stay the same. And interestingly here, responses were more evenly divided than in some of the earlier questions. 44% thought that correlation would increase, with 23% registering that it would decrease, with approximately a third saying that there would be no change in the correlation structure across asset classes as a result of the pandemic. In terms of equity volatility, though, there was a very clear response there. Again, the question on the left-hand side, in terms of the response, very clear majority thought that there would be an increase in volatility. So the volatility of the equity markets was expected to be increasing. And that's important from the point of view of financial advisors in terms of giving advice to clients, maybe to sit tight as markets oscillate up and they oscillate down. And we've seen a lot of that oscillation as new variants appear, and indeed as some economies begin to open and so on. And there's a little bit of a shift in terms of an increase in terms of volatility. And that is expected in terms of our participants to actually stay over the long term, which is an interesting response. Next question was in terms of equity asset allocation over the next 1 year, again, from a tactical perspective. What is going to happen in terms of the tilting, in terms of the types of, or the categories or classifications of stocks? And again, on the question on the right-hand side, we're asking ourselves, is it going to be more into growth stocks, value stocks, defensive stocks, pro-cyclical stocks, or indeed no change in what they were doing pre the pandemic? Interestingly here, over the next 1 year, there was a largest percentage of respondents were going to tilt or suggesting tilting the orientation of their equity portfolio towards value stocks, and 32% of them said that, with the next important category being no change. Very few actually chose to go into defensive stocks. So very interesting result there in terms of value stocks being going to have an increased representation of the portfolio over the next 1 year. So we asked ourselves on the next slide then, which I'll turn to in a second, asking, well, how will that happen over a 5-year horizon? And very interestingly here, the results closely mirror those of the 1 year. And again, the largest percentage of respondents had a tendency towards value stocks being on the increase in their portfolio, a third, with no change being the next most popular category. And again, the other ones not being particularly significant. So again, that shift or tilt towards the value stocks in that regard. Next question we ask, well, what do respondents think will happen in terms of the level of investor risk aversion over the next 2 years? Will that increase, decrease, or indeed not change at all? In other words, what would investors think about the overall market out there? And interestingly enough here, results were evenly divided. Roughly there, a third thinking risk aversion would go up, a third thinking it wouldn't change, and a third thought that risk aversion would decline. So that is an interesting response in and of itself. So even uncertainty as to the level of risk aversion that will be out there in the marketplace over the next 2 years as this pandemic unwinds itself. In terms of the equity risk premium, which is important from an equity perspective, we asked participants, well, what would happen to that? Do they expect the equity risk premium, in other words, the gap between the expected return on the market and the long-term government bond, what would happen to that over the next 2 years? Interestingly here, there was 51% of the participants thought that the equity risk premium would in fact increase, with 25% thinking it would narrow and 24% expecting no change. So that's an interesting contrast with the volatility and the risk aversion responses that participants came up with. Next, what we asked, well, what's going to be the biggest risk over the next 12 months? And we looked, when we discussed this in our think tank group, we came up with a number of possibilities here in terms of, would the pandemic not go away be the biggest risk? Would there be a release in pent-up demand and excess savings coming out as the crisis ended? Will government scale back the level of supports too quickly? Will inflation rise? And interestingly, we have seen that. And will central banks then tighten monetary policy? And interestingly there, we can see slightly difference between what is happening at the ECB level, where there's an expectation that inflation is actually going to be more short-term measure, whereas a little bit more hawkish in the context of the US environment, with maybe an expectation of increasing rates over there, which will have obviously implications. Another question we asked, well, how about a bubble in the equity markets? What will happen to bond yields? Will it be geopolitical risk? Interestingly then, when we look on the right-hand side of the slide then, in terms of the responses, 31%, roughly a third, were of the view that the greatest risk that would be that COVID would not go away. And we can see various jurisdictions throughout Europe at the moment emerging out of the Omicron variant at various kind of trajectory levels. The next significant response that people worried about was inflation rises, leading to a tightening of monetary policy, which would obviously have an implication for consumer spending and indeed for interest rates in that way. So we can see that the preponderance of the responses there were really about that the COVID would not go away, or alternatively, that inflation would take off if indeed COVID did start to abate itself. So none of the other factors that we have identified in the questions on the left-hand side really were significant in investors' minds at all. Next question we asked ourselves, well, in terms of the global equity markets, and we asked investors, or we asked advisors to choose just one possible equity class that will outperform over the next 1 year. And indeed, we also asked on the next slide, well, what would happen over the next 5 years to see would there be any difference. So the equity classes we identified there were on a geographic basis. We looked at US equities, South American equities, European equities, Far East, excluding China, and indeed China. And interestingly here, there was a very, very strong preference across the jurisdictions for US equities going to dominate. Roughly nearly 40% of the respondents across Europe thought that was going to happen. Next came European equities, with nearly a third of them, with the next largest category being China. So therefore, outside of China, so other Far East equities and indeed South America didn't really figure at all in terms of the perceptions of financial advisors at the European level over the next 1 year. So let's see then what happened over a 5-year horizon. Well, over the 5-year horizon, the exact same equities were given, US equities right down to Chinese ones, for instance. Interesting comparison here again, US equities were going to dominate over the next 5 years, but this time China moved into second place. And that's probably because there was a perception amongst advisors that China was beginning to clamp down on tech companies and so on, and that will have washed itself out over the 1-year horizon, with the result then that China would effectively take off then in the 2 to 5 year horizon. So again, interestingly, as we've seen, US equities dominating, with Chinese equities then being the next biggest kind of category over the 5-year horizon. Next question we wanted to ask ourselves, well, what about alternative assets? And do you consider that will grow over the next 5 years? And which particular category of alternative assets would dominate? And we listed particular categories for advisors to consider, going from crypto-related assets through ESG, commodities, real estate, fintech, private equity, and indeed infrastructure assets. And again, as Martin mentioned in his part of the survey, a clear expectation coming out that ESG related assets would dominate, with almost 50% of the financial advisors across Europe indicating that ESG would be the dominant alternative asset class over the next 5 years, with crypto related assets coming in second at 17%, and none of the other categories came in with more than 10% of the respondents saying that they would be a dominant alternative asset class over the next 5 years. Next question we asked ourselves, well, which of the following statements best reflects your view on alternative investments as an asset class? In other words, will alternative investments go up, down, or stay the same, as we indicate on the left-hand side of this slide? And again, in terms of responses, there was a clear majority selecting that alternatives would increase, almost 60% of financial advisors indicating that, with only 5% suggesting that they would decrease. Interestingly, though, 15% of the respondents didn't really have a view what would happen with alternatives over the next 5 years. So that finishes the main results. So just to give you some concluding remarks to encapsulate the main themes that were emerging. First one is that the outlook for the global economy over the next 5 years is tending towards an expectation of high growth and high inflation. And we can see that inflation at the moment has turned out to be quite high, both at the European and indeed at the US and the UK level. In many cases, reaching a high that hasn't been seen for decades. And the question ultimately, is that going to be more permanent, or is it a result of supply chain issues which will eventually disappear? And from a European perspective, there seems to be a view at the ECB that the inflation is going to be more short-term, which case it won't need much of a change in monetary policy, where there's a slightly different view taken in the US environment. Next one, well, over a 1-year horizon, there's a stronger expectation of this high growth and again high inflation. But interestingly, over the 5 years, there still is an expectation across financial advisors that inflation will be reasonably high compared to what it has been before. So that is obviously a worry then from the point of view of financial markets and its implications for interest rate policy. The majority considered that volatility will go up, so it's going to be a lot more kind of a risky environment, and that there would be a higher equity risk premium as a result. There is an expectation that the correlation across asset classes may increase, and that might drive, if that turns out to happen, that will drive a search towards finding yield or finding other asset classes, particularly alternatives or different types of alternatives that will have a lower correlation with the traditional asset classes. So that will be interesting to see how that pans out over the next number of years. Equities are expected to increase in significance across model portfolios, with US equities dominating on both the long term, i.e. the 5-year horizon, and indeed in terms of the short term, the 1-year horizon, with China emerging as the next most important equity market, particularly if one looks at the 5-year horizon. Respondents are universally not particularly bullish on investment in government debt and don't intend to be overweight on it. And at best, they are going to be neutral on it, but a little bit more favorably disposed towards corporate debt, where the search for yield may achieve good results. Interestingly, value stocks are expected to dominate both over a 1-year and indeed a 5-year horizon. And this seems to indicate that advisors expect a movement away from the traditional growth stock category from that perspective. And then the dominant risks then, finished up, are either that COVID would linger, and we can see that, but happening at the moment in terms of different jurisdictions, or alternatively that inflation will rise, resulting in a tightening on monetary policy. And just to summarize then, I think inflation looks like to be a real and present danger. And the question is, ultimately, will that inflation turn out to be short-lived or indeed more long-lived? And that is one of the great uncertainties going forward. Thank you very much.
Hello, I'm Matthew Connell. I'm the chairman of the EFPA Standards and Qualifications Committee and work closely with Paul and Martin and other members of the committee to develop EFPA's syllabus and to develop thought leadership work like this excellent research that Paul and Martin have prepared for us. Well, thank you so much to Paul and Martin for those excellent presentations. And I think it really shows the unique resource that EFPA has in its membership to collect these fantastic insights. I guess one thing that comes to me from the insights is that a lot of investors are keeping their heads and sticking to sensible assets. And then I guess in terms of the way in which people think about the future, I think kind of the future, the culture wars that have rage on social media and that we see on the news. Investment doesn't work in a bubble, and we've seen perhaps some of these elements of these culture wars in some of people's expectations of the future. So on the one side, there's the sensible sort of technical approach of just improving investments and society across the board. There's the ESG approach, which is looking in a very technical way at the challenges facing us all and translating those challenges into an investment to make sure that the kind of risks of the inevitable changes around coping with climate change and social change are anticipated by investment approaches. And then there's probably the other side of the culture wars. There's the crypto approach, which is perhaps a completely alternative approach that leaves out sort of central banks and governments maybe hunkering down for an apocalypse of government failure and government incompetence. So there's kind of elements of those culture wars feeding through perhaps to the investment choices that are open to people. But it seems, I guess, the message is that for the bulk of investors, it's still sanity reigns, and there's still an approach of adapting to the future, but adapting to the future in a measured way. And obviously, there's nothing more important for investors in any market than the guidance of a trusted advisor in helping us reach those goals. So again, thanks so much to Paul and Martin for your insights, for your dissecting the market with such skill and such clarity. And thank you to everyone who's listened to this recording and joined us at the original event. Many thanks to everyone, and I hope you keep connected and watching what EFPA does in future. Thank you very much.